The 4% rule. Everybody's heard it when you're dealing with finance and retirement. It's getting a makeover. Is it worthwhile? Is it a bump to your retirement plan, or is it just headlines? Let's get into it this week here with Scott Osborn on the Wealthy Pilots Podcast.
We've got some turbulence up ahead.
Hey everybody, welcome in. Thanks for hanging out with Scott and I as we talk investing, finance, and retirement. Of course, Scott is the airline's advisor here helping folks get to and through retirement. And Scott, let's talk about the 4% rule getting a little makeover by the guy who came up with it. So at least it's not like totally willy-nilly. It's the guy that came up with it. But what's going on, my friend? How you doing?
Living the dream, brother. How about you?
Hanging in there, rocking and rolling. And I guess what we ought to do is maybe give a little bit of background on the 4% rule. But I gotta wonder if this guy who created this, and I'm sure you're going to give us the details, thinks, man, this thing took off when he created it like 30 some odd years ago. It became the default that everybody uses in every kind of scenario. So he's got to be kind of proud of that, I suppose. But at the same time, it's a rule of thumb. So break it down for us.
Yeah. So, I mean, what you're really going to hear about this is like the safe withdrawal rate. And what we mean by safe withdrawal rate is I look at my portfolio, I retire, I'm no longer getting income from my job, and I'm drawing income from my investments. So, there was, back then it was kind of like, well, how much can I draw out of the investments? You got to think like pre-90s, almost everybody was on Social Security and pensions, and that's it. And so as 401ks were becoming more and more popular, this need for basically like best practice or rules of thumb or whatever the case is became necessary to try to figure out how much can I withdraw out of this portfolio to pay myself, but also stay invested in the market, but also ensure when the market is down, I'm not going to run out of money because I don't want to run out of money. And so basically what they kind of came up with this rule of thumb is, hey, in a balanced portfolio, 50% stocks, 50% bonds, over 30 years, you can take out an inflation adjusted 4% annually and never run out of money. And that was based off of the historical U.S. market data for U.S. stock performance, and then bonds as well. And
it was 50-50, right? That's
yes.
what he was originally was doing. Yeah.
Yep. So the portfolio was 50-50. And so so basically what they came up with this rule of thumb that you could take 4% out. Right. And I look at different recessions in the 70s and 80s. And when the market's down, if I'm pulling 4% out, in this model, it's like, okay, I'm pulling the bonds out while the stocks are down. I let the stocks come up, and then I'm selling stocks to pay myself when stocks are up and bonds are down. And that's kind of what they came up with to, enable folks to take that 4% out. And again, adjusted for inflation, which means if I had $100,000 or $1 million in my portfolio, I pulled out $4,000 or $40,000 this year. Next year I'm tacking on 3% of that. So I'm pulling out, $42,000 and whatever the case is, and I compound that over time. So, and so the inflation adjustment is an important part of that, because cost of living does go up even if you're retired. And so, we want to make sure that the withdrawal rate is going to account for that. But that 4% should still be there, right? We're just saying that the portfolio, in essence, would be growing to account for larger distributions. So.
Okay. And so what he did is he moved it to 4.7. Now, I find that funny because, talking with financial professionals as much as I have the last 10 years, it seemed like the 4% rule, people would say, well, it's really more like the 3.2% rule because we want to make sure that we're not running out of money. And it was kind of being adjusted, to your point, for all those different scenarios. Yeah. But now this guy who created it has set up some new numbers that calls it 4.7 and is going 55-45 with the asset split. So what's your thoughts there?
Yeah, I mean, I tend not to be a big like rule of thumb guy because so many times these rule of thumbs get pushed out there and it manifests in people creating a spreadsheet. I'm a big spreadsheet guy. It's no problem, but they got a spreadsheet and they're like, all right, here's my balance. Here's my distribution rate. And they just drag the cells across and say, all right, with, level stock market performance with this 55-45 portfolio, it's getting 6% a year. I can take out 5.7 and with portfolio growth, blah, blah, blah. And so, they're ignoring volatility. However, when we just draw and do the drag and drop of my cells across, your retirement, it looks good, but it's ignoring volatility. And that's why we have to, in essence, run what we call Monte Carlo simulation where we
Right.
look at that and we'll look at all these different inputs, right? Of market performance, inflation, bond performance, tax rates, increases in Medicare premiums, increases or decreases in taxation of Social Security. There's a lot that goes into that, but that Monte Carlo is really, hey, it's running like 10,000 different scenarios of all these different things, and then it's going to spit out a probability of success.
Yeah.
I always call it a probability of adjustment. Like, hey, we might have to make an adjustment, throughout retirement. That's going to be normal. But
Yeah.
But in essence, what we're looking at here is they're basically saying, hey, if we tilt more towards stocks, we could probably tilt more towards a closer to 5% withdrawal rate. And again, it says it's meant to reflect today's data is kind of the theory behind it. Hey, looking back at today's data, we have more sophisticated planning tools, more sophisticated financial planning software. But
and the bond market being terrible for a couple of years, I'm sure affected some of that too.
Yeah, I mean, when you were coming out of the recession in 2009, and we had basically a decade of stocks being flat. I mean, they weren't flat; they were down and then up, and then down and then up. But over that lost decade, if you held it, you basically made no money for a decade. And ultimately, out of that scenario, they were saying back then, hey, the withdrawal rate should probably be more like 3.2%. Okay, well, 3.2 makes sense when stocks are not going to perform at all, and they're going to get cut in half twice in a decade.
Yeah.
Well, now that we've been on this larger bull market, I mean, we've had a couple corrections in here for sure, a couple bear markets, but we haven't really had when you look at how the S&P 500 does in a recession, in a deep recession, the S&P 500 has dropped below at least 44% every single time. We've not had that since 2008.
Right.
Okay. And so, we got a whole generation of professionals here that have had, their highest earning back halves of their career and doubled their net worth, if not tripled it, and are working on their retirement plans that have been a little spoiled, candidly. And I think, if we got a period of flatter S&P 500 returns in our future, that's going to confuse some people why, their portfolios are not performing as well as they used to, even though I'm owning the same asset class, et cetera, et cetera. And so I think there's a little bit of noise in this data set where, hey, well, we can withdraw more now because the market's done well this last, 17 years. Well,
Yeah.
Is it going to keep doing well or not? I don't know.
Right. Well, that's what I was going to ask you too, right? So, I mean, inherently the problem with the 4% rule, and if you just want to stick with 4 for easy math right this minute, you got $1 million portfolio, 4%, 40,000 a year. That's what you pull out, to fund your retirement, right? To shore up the gaps. But every situation is different, right? So somebody might say, well, I really want to take more risk because I want to leave a bigger legacy. Well,
Yes.
Okay, you could do that. Maybe because you and your spouse both have pensions and you both have a good Social Security. Well, that's going to allow you maybe to take more risk and not pull that 4% or whatever. So every situation, it's a good rule of thumb to kind of get you some back of the napkin quick math. But I think at the end of the day, to your point, you really got to dive in and see, because what you have versus what your neighbor has is totally different setup.
Well, and again, this is why I don't like rules of thumb, especially, doing what we do for people. We're figuring out, what does your plan call for? I mean, I have some people that, they're I got a husband and wife couple who are the same age, very close in age, both had really good careers, both going to have really, really attractive Social Security payments or payouts. And so they retire at 65, and it's like, well, you can take your Social Security now, and then you're both getting about, $4,000 a month of Social Security. And then you want to take some smaller distributions, and that 401k will grow, or those now IRAs will continue to grow. Or we can delay Social Security. And I think their payments were going to be closer to $3,000, and they're going to grow to like $4,600 a month. Well, you start looking at it and running the numbers, and then they start to figure out, well, man, if we can wait to take Social Security until we're both 70, our Social Security payment alone is going to cover over 90% of our life expenses.
So you're not tackling your own pot of money as nearly as much.
For sure.
Yeah.
And so, if I can get 90% of my lifestyle covered with fixed income, I'm assuming Social Security is pretty guaranteed, backed by the U.S. government. Not everybody trusts that, but I think Social Security is pretty reliable for the foreseeable future. I think they're going to figure out how to fund it regardless, but that's a whole nother podcast.
That's
but
right.
I think if I can have 90% of my income covered Well, maybe this 5-year period we spend some of that IRA down. So they were at like a 10 to 12% withdrawal rate, which, you could say that's crazy. Yeah, that's not sustainable for an entire retirement through, probably multiple deep recessionary periods, et cetera. But for a short period of time where you're spending that down and still enjoying your retirement, letting that Social Security, build up. And then, and actually this year they just flipped the distributions down to, now they're at like a 2% distribution rate, and they're not going to need more than that because almost all of their lifestyle is completely covered by Social Security. And so, and now that IRA balance will start to grow and recover. So it's just kind of an interesting, way of how do you want to handle it? Not everybody's going to want to wait to take Social Security. That's okay. But your plan should dictate what's going on here. And then we got to do a risk analysis to say, hey, does it still make sense? And, run that Monte Carlo and make sure that, okay, if we spend this much of it down and then you retire and you have a smaller balance when your Social Security turns on, does all that still check out? And then it's almost like you run another analysis for 5 years from now when they're both 70. Okay, it checks out. Let's do it. So,
well, if you're pulling 4% too, depending, let's not forget this as well. So if the thought process and the conversation is around the 4% rule this week, if it's depending on the kind of account it's in, Scott, you may not have $1 million, right? So if we just kind of go with what I just did, it's $1 million, 4%, 40,000. But if it's in a traditional IRA or you work 401k, guess what? You got a partner. You ain't got $1 million. Like you got like 700,000, right? So are you now you're pulling 4% off of 700,000. That changes the number. And if you do in a down market, if you happen to retire in a down market, all of that stuff's got to be what's factored in, and you've got to be updated and checked on, annually.
Well, and this is where, when we're working a retirement plan for folks, we're looking at like 3 classifications of money, right? We got our we call it taxable, but it's after tax money in some sort of individual or joint brokerage account. Your dividends are taxed, your capital gains are taxed, but it's not income tax. Okay. Other than maybe a portion of the dividends. We have our tax deferred account. Most people's 401ks are in that pre-tax tax deferred account. Then we have the tax free forever bucket. That's like that Roth money. Not that many people have very much money over there, but everybody in retirement wants to get more money over there. So a lot of times what we'll do is, hey, let's have a bucket of after tax brokerage account money for us to live off of early in retirement. And let's let that Social Security build up. And then let's take that pre-tax money while we're living off of this, which again does not hit your tax return as income. And then we'll convert large chunks of this money from pre-tax over to Roth in lower tax brackets. And then by the time you hit age 70, your Social Security turns on. We're probably about done spending down that taxable brokerage account. Our pre-tax has been significantly diversified over to Roth. And then now we're able to live in lower tax brackets in retirement. All that is some key kind of planning things, but you're going to probably do some violations of 4% or 4.7% distribution rules because we're prepaying tax bills and all that kind of stuff. But it's more so, where do we want to land long-term in retirement? How do we, diversify ourselves from a tax standpoint? How do we get good investment performance? How do we make sure the checking account's going to get paid the rest of our life? Because a checking account doesn't care how it gets paid. It can come from any account. It doesn't care what the taxes you paid. It just knows I need to get fed every single month and I need to get a raise every single year because cost of living is going to go up. And so, ultimately it still comes back to, yes, it's a good rule of thumb based off of all sorts of data sets, but there's not a one size fits all answer. I hate to tell people. And
absolutely,
most of these rules of thumb, when people are doing it themselves, they also implement it incorrectly. You look at, Bill Benjamin, the guy that came up with this 4% rule. This is like a PhD level thesis, right?
Yeah.
For him to get this data set and all this analysis and then, on the implementation side, you got people again, just doing a drag and drop across, 25 years worth of Excel cells. And I'm sure like William Benjamin's like, no, this is not,
not
like,
what I intended.
The data set's a little more complex than that, guys.
Yeah.
And so, that's where I think you got to be a little careful with just following rules of thumb without actually looking at what is best for me and my household. What is the best plan I should develop for myself? Can I take a little bit more risk on, increasing the income I have? Maybe we build a plan to really enjoy the decade from age 65 to 75. and hey, we're okay being a little bit more aggressive to enjoy those younger years. And so, ultimately it comes down to risk management, how much risk are you willing to take? And your goals in retirement for lifestyle, taxes, legacy, et cetera, And so, if you don't want to leave any money behind to your kids, or you have no kids, you can probably have a little bit larger, withdrawal rate. And so, there's definitely some brackets, I'll say, where you start to get above, 6%, it's going to get pretty hard to sustain that in some time periods. And then obviously if you're below 3%, you're probably going to be able to endure any investment environment. So it's more so what is in the best interest of the household and what makes sense.
Well, if you guys want some help and you want a great way to get started, go check this out and get your retirement toolkit today.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
All right, Scott. So at the end of the day, right? So again, the 4% rule kind of took over. It kind of became this, before things were viral, it kind of became viral, if you will, in the financial services world, right? Everybody's heard of it. Everybody kind of is familiar with it. But at the end of the day, people just want to know, what's my withdrawal rate? What's my personal withdrawal rate? And you can't back of the napkin that, right? You have to run an analysis and you have to run a strategy to find out. Because again, we just highlighted a bunch of ways the last 15 minutes here is going to affect. Every scenario is going to affect that. So what's the best thing to do? Come in and sit down with someone like yourself, right? And run those strategies, get those numbers put in place to see what it's going to look like to get your, personal withdrawal rate.
Well, and I think at the end of the day, rules of thumb they're good conversation starters. They're a good starting point, but that shouldn't be the end of the conversation. And I definitely don't. It's just diet and exercise stuff too. It's you don't want to read anything you see on the internet and say, oh, well, let's just implement that because I like the talking head on TikTok. No, it's what makes sense. What does the math say? And then, again, look out at the market environment. If we're coming off of 15, 17 years of well above market performance, that might be a time to maybe be a little bit conservative early in retirement, or maybe pay off some extra debt so I have less going out the door in retirement, whatever the case is. So we shouldn't look back and say, well, this has been good the last 10 years, so it's going to be good the next 30. We got to account for some of the storms that we know we're inevitably going to have in a 30-year retirement. So again, those rules of thumb they're not inherently good or bad. They're good conversation starters, but they should be starters. That should not be the end of the discussion. So
Yeah, back in the napkin stuff is great to kind of get you in the ballpark, but then you got to really dial it in. So reach out to Scott if you got some questions, need some help, and you want to dial in your situation to make sure that you're doing the right things for yourself with your pilot. If you're not a pilot, whatever the case is, make sure you're talking with a qualified professional like Scott Osborn before you take any action on something here on our podcast or any others. And you can certainly get some time on Scott's calendar. We got the links in the show descriptions below. Go to retireairlines.com. That's retireairlines.com, if I can talk, and get yourself some time onto the calendar. Don't forget to subscribe to us on Apple, Spotify, and YouTube, of course, and share the podcast with others that might enjoy the message or might benefit from talking with Scott. You can find us again on all those platform apps, and don't forget to subscribe to us, hit the thumbs up button, notification bell, all that good jazz. Scott, my friend, thanks for breaking down the 4% rule as always. I'll see you next time.
See you soon.
We'll hit you next time here on the Wealthy Pilots Podcast with Scott Osborn.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.